Hello, welcome to this ninth class of our journey towards finance for non-finance. Till now, we have discussed about different transactions individual wise. From now onwards, till 12th session, we shall discuss about all these transactions into balance sheet and profit and loss. So from 9th class to 12th class, we shall discuss about different financial transactions, and a business entity generally performs for a particular period. We shall take about 3 months period, and during these 3 months, how from individual transaction carried out by the business entity over a period of the time, how the business entity will build up the profit and loss and balance sheet. What we will be doing, we will be using the same principle what we have learned till now and presenting it in profit and loss and balance sheet format. Now in these sessions, after the completion of these sessions, what you will be able to understand how profit and loss and balance sheet is developed from the financial transactions carried out by the business entity. As we have discussed that every financial transactions has an implication of inflow or outflow, and this inflow or outflow is captured by passing a double entry system. Let us explain these entire concepts with the help of series of financial transactions a business entity will undertake for a period of 3 months. As we know, the financial transactions would be captured in two statements. One is balance sheet, another is the profit and loss. In the balance sheet, we segregate the balance sheet, equity and liability, into two parts. One is an equity. Next one is a non-current liability. What is an equity? When a promoter starts a business, whatever the money promoters brings in is called equity. Similarly, when a business entity borrows from outside and the borrowing is taking place in such a way so the amount will be paid after 1 year, that is called non-current liability. Then when a business entity takes money from outside and the money has to be paid within 1 year, that is called current liability. So these three are the components of equity and liability of the balance sheet. Asset side, we have fixed assets. Fixed assets are plant and machinery, furniture, fixture, which is used for sales purposes. Then we have non-current assets, mainly the investment in shares, investment in FD, which would be liquidated after 1 year. And then current assets like inventory receivable, which would be liquidated, which would be converted into cash within 1 year. So these are the three items of the balance sheet asset side. Let us now start with capturing the financial transactions and see that how financial transaction is translating into accounting entries and how step by step the profit and loss and balance sheets are built up. As on April 2nd, 2019, two shareholders invested rupees 50 lakhs each in the form of capital for setting up a manufacturing company by depositing the amount in the bank account of the company. As we can see from the transaction, on behalf of the company, it's an inflow of fund. Inflow of fund taking place immediate. So as we know, the first entry would be debit because inflow, balance sheet, asset, bank. So first entry would be the debit, balance sheet, asset, bank, 100 because 50 lakhs, 100 lakhs. This we are using the same principle what we have discussed till now. So second entry would be definitely credit because first entry is debit. Second entry is credit, and this is on account of money brought in by the promoter. So in this case, it will come under the head capital 100. So if we look at it, so from the first transactions is captured by passing two entry, one debit balance sheet asset bank 100, credit equity and liability capital 100. Same principle which you have discussed in the previous lectures are used. As on April 4th, 2019, the company gives 5 lakhs check for security deposit to the owner of a shed. So here it's an outflow of fund. If it's an outflow of fund, first entry would be credit. An outflow of fund immediate in the form of a check. So credit balance sheet asset bank 5. I'm putting it in red mark 5 because on asset side, if something comes credit, it would be deducted from the debit balance. So after this, now the second entry would be debit balance sheet asset security deposit 5. Why it is security deposits? Because here on account of security it is giving and the money would be realized after 1 year. Because it is expected that when the company gives the security deposit for shed, it would be using it for beyond 1 year. So debit balance sheet asset, non-current asset, security deposit 5. Now, in this case, in the bank balance, there is a previous debit entry of 100 and now a credit entry of 5. So you will put a net figure. Net figure is coming 95. Now, if you look at the total of the asset and liability side of the balance sheets are equal. Asset side 5 plus 95 is 100. Liability side 5 plus 95 is 100. So this is the uniqueness of double entry system where it should be matched. Let us proceed. Now what is happening? On April 5th, the company purchases machinery worth of rupees 50 lakhs by paying a check to the supplier of the machinery. Very simple concept. It's an outflow of fund. Outflow of fund immediate. So if outflow of fund immediate, first entry would be credit balance sheet asset bank 50 lakhs. Now what would be the second entry? Second entry would be debit. Now this is on account of purchase of assets, plant and machinery, which would be used for more than 1 year for generating sales. So in that case, debit balance sheet asset, fixed assets, plant and machinery, 50 lakhs. Now same principle will apply in the case of the bank account. So bank account, now the bank account total would be 45. And if you see the total of the asset side is 50 plus 5, 4,500, liability is 100. Let us proceed further. Now if you look at it, now I am putting it bank balance here. On April 5th, the company hires 10 people, total monthly salary of 3 lakhs, and the same would be paid in the beginning of the month. So if you look at it, the same would be paid in the beginning of the month, either paid on the 7th of succeeding month. Now, in this case, what is happening? It's an outflow, but outflow on account of what? Outflow, deferred outflow. So it's an outflow. So first entry would be, so in this case, what will happen? This will not be captured in the month of April. It will be captured in the month of May 7th. April 6th, the company purchases raw material of 30 lakhs by paying a check to the supplier of raw material. A very simple common sense. It is purchasing raw material by giving a check. So outflow of fund. So first entry will be the credit balance sheet asset bank 30 lakhs. Since it's an outflow, I am marking it in red. And what will be the second entry? Debit balance sheet asset, current assets, inventory, raw material 30 lakhs. Why it's a current assets? Because when an entity purchases raw material, it is expected that the raw material would be used within a year and converted into sales. So that's why it is current assets. Now, if I apply this, now the bank balance would be the net balance. Now again, if you look at on the asset side, it is 50 plant and machinery, 5 is security deposit 55, and then raw material 30, bank is 15, so total is 100. Now from April 6th to April 30th, following transaction takes place. Now the company consumes 20 lakhs of raw material for production purposes. Let us look at it. When a company is consuming 20 lakhs of raw material, what is happening? this raw material is moving out of inventory. Since it is moving out of inventory, it's an outflow. Now, if you look at it, so first entry would be credit, balance sheet, asset, current assets, raw material, 20. Why we are marking it in red? Because it's an outflow is coming and it's in credit balance. As we have discussed, anything credit on the asset side would be marked as a negative. Now, what would be the corresponding entry? The second entry would be the debit. But debit, when an entity consumes raw material, it is permanently consuming it. Since something is permanently consuming it, and it would be permanent outflow is happening, or permanent expense is basically consuming, so it would be expenses. Same principle we are applying, what we have discussed previously. So debit, profit and loss, expenses, consumption of raw material of 20 lakhs. If you look at it, till now, only entry was coming in balance sheet. Now, entry is coming in both balance sheet and P&L. Now, let us look at it. So, what would be the closing balance? So, the raw material would be 10. Now, bank balance would be 15. And if I look at it, that is the right-hand side. If you see right-hand side is 100. That is, asset is 100, liability is 100. However, what is happening? There are some expenses has happened, and these expenses, how do we capture? That we will discuss slightly later on. Now, the company incurs salary expenses of rupees 3 lakhs for production purposes, and the payment would be made on 7th May. So this is on 30th, we are booking the entry. Since it will be paid on 7th May, it is a deferred outflow. If it's a deferred outflow, the first entry would be credit, balance sheet, liability, current liability, and creditor expenses 3. Now, second entry would be debit, profit and loss expenses, salary 3, because since it's a permanent outflow is happening. Now, the company incurs electricity expenses of rupees 2 lakhs for the month of April, and at the end of the April, it will book that expenses. However, the payment will take place on the month of 15th of May. So same principle, since it's an outflow, deferred outflow, first entry will be credit, creditor expenses 2, and debit electricity expenses 2. Now for up to 30th April, these are the transactions we have captured. Now, if we want to close this on 30th April, something called matching principle comes into the picture. What is a matching principle? Matching principle says that expenses incurred for a period may not generate sales for that period. Since it is not generating for that period, so it will not be treated as an expenses. It will be recognized as expenses for the period when sales happens. So during the period in the month of April, the company has incurred an expenses of 25, but sales is not happening. So here we have to pass a matching principle. That means we have to pass an entry which will reduce the expenses. Now, when these expenses will be booked, when the sales will happen. Now, how we book these expenses? Now, raw material has been taken out from the stock. Along with the raw material, some expenses on account of salary and electricity has been incurred. And these raw material, along with the expenses incurred, salary and electricity, this is something semi-finished goods have been prepared and it is lying in the shop floor. So there is something called work in progress has come. Now, in this case, what will happen? Work in progress is lying in the shop floor. This should be valued by using costing methodology. By applying the costing, the management will value it. Now, what we assume is that the entire amount of raw material, salary and electricity, raw material consumed, salary and electricity expenses has been used to prepare the WIP. So that means the entire raw material has been used and is lying in WIP. And the cost of the WIP is 20 plus 3 plus 2 is 5. Now, if we see, this is called valued at cost. The company would also calculate the market value. What is the market value? If I sell it at this moment, what would be the market value? If I find out the market value is 28 lakhs. However, the valuation of WIP will take place by matching by a principle is that the market value or cost, whichever is lower. So in this case, WIP value would be 25 lakhs. So I will pass a matching entry. I will pass an accounting entry adopting matching principle. Now, what would be the entry? First, the entry would be debit balance sheet, current assets inventory, WIP 25 lakhs. Now, second entry would be credit P&L expenses, increase in WIP negative 25 lakhs. So what is happening here? What is the matching principle? If some income expenses is incurred, but sales could not take place, that amount of expenses would be reduced. And for that amount, the inventory in the form of WIP or finished goods will appear in the balance sheet asset size. Now, when we do that, we have to create a value which is cost or market value, whichever is lower. Now, this is called matching principle. Now, let us look at it. After this period, what would be the P&L? P&L, if you look at it, is 25 lakh expenses, negative 25 lakh, so zero. On the asset side, we have the total asset amount is 105. How? 50 plus 5, 55, 65, that is 90 plus 15, 105. And on the liability side, we have 105. So what we have done, for the month of April, starting from 2nd April, we have captured series of financial transactions. And at the end of the April, we have created a balance sheet and profit and loss for a business entity. So now you have got an idea how P&L and balance sheet are prepared by using the same principle which we have done from first lesson 1 to lesson 8. We shall see how the other entries are captured in the subsequent lectures. Thank you so much for listening to these lectures.